You ever feel like you need a finance degree just to understand what's going on in the news? Yeah, you're not alone. So today, we're going to cut through all that noise. We're going to walk through a simple, really powerful investing strategy that has worked for decades. Let's dive in. I mean, every single day, it's a new headline, right? A total whirlwind. Buy this, sell that, a bubble's coming. It's all designed to make you feel like investing is this super complex game that only the experts can win. But what if I told you the best strategy was actually the simplest one? The truth is, there's a much simpler, way more powerful path to building wealth. And today, we're going to walk through it step by step. By the time we're done here, you are going to have a super clear plan. All right, first things first, we've got to tackle a fundamental problem. A lot of people think the absolute safest thing you can do with your money is just let it sit in a bank account. But here's the catch. Doing nothing is actually a guaranteed way to lose money. Slowly but surely, let's see why. And the culprit has a name. Inflation. It's that silent force that makes prices for everything, from your coffee to your rent, go up over time. So that $1,000 you have stashed away today, well, in a few years, it might only buy you what $800 buys now. Your money is just slowly losing its power. Okay, and this right here leads to a really crucial idea. If you look back through history, the value of assets, things like stocks or property, has grown way, way faster than salaries. While our paychecks have barely kept up with inflation, owning a piece of a growing business has been this incredible engine for creating wealth. It's this huge shift in thinking. Real wealth isn't just about what you earn, it's about what you own. So the big question is, how does a regular person like you or me get a piece of this action without becoming some Wall Street guru? Well, the answer lies in one of the most brilliant and simple inventions in all of finance, the index fund. Now, this slide breaks it down perfectly. You've got two main approaches. You could try to pick individual stocks. That's like trying to find the one winning horse in a massive race. It's high risk, high effort, a ton of work. Or you could buy an index fund. And that's like placing a small bet on every single horse in the race. You're not betting on one competitor, you're betting on the race itself. And man, this is the perfect example of the risk you're taking. Remember BlackBerry? They were the kings of the world, right? Absolutely dominant. But even the biggest, most powerful companies can stumble. Trying to guess who's going to be on top tomorrow is it's incredibly tough, and getting it wrong can hurt. So what is an index fund, really? Just think of it like a shopping basket of stocks, all prepackaged for you. Instead of buying one share of Apple, you buy one share of a fund that holds Apple and Microsoft and Amazon and nearly 500 other top US companies. In one click, you own a tiny piece of the entire market. And this is where the magic really happens. Just look at these numbers. If you had put just $100, into an S&P 500 index fund back in 1996 and just left it alone, it would be worth over $1,700 today. That didn't come from clever trading or risky bets. That's just the power of owning the market and letting time do all the heavy lifting for you. And that is exactly why diversification is your best friend. The top companies are always changing. The giants of the 70s are not the giants of today. The coolest part about an index fund is that it does all of this work for you. It automatically phases out the old companies and brings in the new leaders. It's like it's on autopilot, so you're always positioned for the future without having to guess what that future will be. Okay, so right about now, a lot of smart people start asking a really good question. They say, wait a minute, if everyone just buys index funds, won't that create some kind of problem? It's a great question, so let's tackle it head on. The worry, right, is that all this passive money just flooding into the same handful of giant stocks, like Apple and Nvidia, is artificially pumping up their prices and creating a bubble that's totally detached from their real value. And, you can see why people are worried. The data backs it up. As you can see here, the top 10 stocks now make up a huge 34% of the S&P 500's total value. That's the highest it's been in decades. It's easy to look at a chart like this and feel a little nervous. But that number, it doesn't tell the whole story. To get the real picture, we need to look under the hood at what's actually driving these prices. And spoiler alert, it's not just popularity, it's profits. And this is the absolute key. Yes, the total value of these top companies is at an all-time high. But guess what else is at an all-time high? Their earnings, their profits. These top 10 companies aren't just popular, they are profit-making machines, generating over a quarter of all the earnings in the entire index. Bottom line, they're big because they're earning big. This isn't just hype. So who actually decides what a stock is worth? It's not the people buying index funds. The prices are set by millions of active traders, hedge funds, analysts, people like you and me, all doing the hard work, the research, digging through numbers, trying to find an edge. They're the ones who do what's called price discovery, making sure a stock's price actually reflects its true value. And believe me, this active market is not some small niche thing. We're talking about a staggering $13 trillion. This massive pool of money is constantly scrutinizing and challenging stock prices. The passive strategy literally couldn't work without them. They set the prices, and we just get to ride the wave. All right, so we've covered the why. The theory is solid, the strategy is time-tested. Now let's get to the good part, the how. Here is a super simple 4-step plan you can use to get started. And honestly, it really is this simple. Step 1, open an account with a big, low-fee investment platform. Step 2, put some money in it. Step 3, pick one, just one, broad index fund, like one that tracks the whole world or the S&P 500. And step 4, and this is the most important part, put it on autopilot. Set up a recurring investment every single month. That's the key. It takes the emotion out of the game and ensures you're consistently building wealth over the long haul. Okay, so we've talked about the strategy, we've tackled the whole bubble concern, but what's the single biggest risk for you as a new investor? It's probably not what you think. It's you, it's us, it's our own brains. It's that little voice of panic that screams, sell, when the market takes a dip, or the voice of greed that tells you to dump everything into some hot new trend. The biggest threat to your long-term success isn't the market. It's your own emotional reactions to it. Your simple, automated plan, that's your best defense against your own worst instincts. And that really brings us full circle, doesn't it? Passive investing works because active investing is out there thriving. The market is this beautiful, weird ecosystem. It functions because millions of people are out there every day trying to outsmart each other and win big. And as a passive investor, you get to benefit from all that hard work, all that chaos, without having to play the game yourself. You just bet on the whole field, which over the long run has always been a winning bet.